welcome everybody to another one of Mariner Wealth Advisors webinars. So my name is Jude Grimaldi. I am a member of our practice management team here at Mariner, and I'm joined today by my team member, Vice President and Estate Planning Consultant, Scott Luhnau. And today we are going to be talking all about charitable planning. So just a couple housekeeping items first. So first thing, we want to make sure that this session is engaging, and we want to make sure that we're getting all of your questions answered as well. So if you do have any questions, feel free to send them inside of the Q&A button that should be at the bottom of your screen there. And then if you have any other questions, comments, concerns, you can always feel free to shoot that inside of the chat as well. So as far as our agenda today, first we'll talk about the potential impact that charitable giving can have on taxes. We'll also cover impactful estate planning, IRA considerations, investing and gifting alignment, and best practices for using assets to fund philanthropy. Now, just an additional note, we will be sending out the recording and the slide deck to all of the attendees as well in a post-webinar email here. And then, of course, if there's any questions that come up throughout the session, feel free to send them up. And if I don't get to them in the beginning of the session or during the session, I'll definitely get those done at the end here. So I will go ahead and pass things over to Scott.
Thanks, Jude. So because everyone here on this call is in a different place when it comes to charitable giving, I wanted to talk for just a couple of minutes and start off by talking about the psychology of charitable giving. And there's really two extremes when it comes to this. So one extreme is a situation where you go to your CPA or your tax advisor and say, okay, show me how much money I need to give to charity to get the maximum charitable income tax deduction on this year's tax return, right? And there's actually a Supreme Court case that we learned about in law school in our tax course. And the Supreme Court justice said, there is nothing wrong with American citizens arranging their affairs in such a way as to pay the least amount tax possible. So even though that's really tax driven, I would argue there is absolutely nothing wrong with that approach if you're giving to charity to get tax benefits, because the charity benefits in the end anyways. So the other end of the spectrum is really what I would call a person who is a philanthropist. They give because it's part of their DNA. They just want to be as beneficial as they can to as many causes and people as they can. And, you know, tax benefits is really of secondary concern for them. And for those people who lean more towards the philanthropist, there's a huge impact that you can make with charitable giving. And I'll give you an example. There was a couple, a husband and a wife that I worked with for many years. And the husband was a corporate executive, high-powered corporate executive. And at every financial meeting that we had with this couple, the topic of charitable giving always came up as part of their annual plan, their tax planning. And it was really the wife that was driving this. She had this heart and this passion for charitable giving. And the husband would grudgingly agree to it, primarily because there were tax benefits, but also to keep the marriage happy. Well, unfortunately, the husband got cancer and he died. And after we got through the estate settlement process and the dust settled, I'll never forget my first meeting with the wife where we talked about, okay, now that you have all of the money at your disposal and you're by yourself, what do you want to do differently from a charitable standpoint? And it turned out she had a few charities in mind that she wanted to give to, and she wanted to do some substantial lifetime gifting and also gifting at death via her estate plan. And when I say substantial gifting, it's, you know, 6 figures to this charity, 7 figures to that charity. And what we had to explain to her was she's in a totally different position now when it comes to charitable giving. And what ended up happening was she made appointments with the presidents of these charities. And she explained, look, I really believe in your charity and I really want to give substantially to it, but here's how I want my gift to be used. So again, the more money you give, the more influence you might be able to have with the charity of how that gift might be used. So let's talk about identifying charities to give to. Again, I would say that based on my experience, there's 2 extremes that I've seen. So the first extreme is this. There was a client who passed away, and we were named as the executor of his estate. And one of the things you have to do when you settle somebody's estate is prepare and file their final personal income tax return, 1040. And so we're gathering the information on all of his income. And when it comes to his deductions, he was a widower, right? So he was alone for many years before he died. And one of the things he would do, it turned out, to pass time is to write checks to charity. And it turned out that he wrote anywhere between 200 and 300 checks per year to charity. So he would get a card in the mail from, charity. There would be some pictures on it that would make him go, okay, this looks like a good charity. And he'd write a $25 check, or a $50 check, or a $5 check, or a $100 check. They're all very low amounts, but 200 to 300 checks, which would add up to several $1,000s that we could use as an income tax deduction on his tax return. But again, he was on so many mailing lists. You also have to get the mail forwarded to you when you settle an estate. So, each week in the mail, we got dozens and dozens of letters and cards from charities asking for money. So it was just like this multiplier effect. And then you have the other end of the spectrum where you have people that are passionate about 1, 2, or 3 charitable causes, and that's really what they focus on. And some examples that I've seen are where maybe a family had a child who was in the military who died, and the Wounded Warrior Project is their main focus. Or you had a family member who died of a certain illness or disease, and then they focus on charities that do research and treatment for that particular disease, right? So then there's those really focused situations as well. But if there's a lot of charitable giving that goes on, one of the really helpful things to do is to do a charitable giving analysis. For example, for this man who passed away that wrote $200 to $300 checks, to show him, look, here's all of the checks you're writing each year. Here's all the charities that they're going to, and here are the categories that they're in, right? So you're giving, 10% of your money to arts and culture, and maybe 80% to education, and then a few other percentages here. This could really show people, even though they might not know it, where they're sort of subconsciously focusing on their charitable giving. So when it comes to tools to help you figure out where you might want to focus your charitable giving, there's 3 main areas that I would suggest you look at. One of them is GuideStar. So GuideStar is this huge database on charities that has information on them, such as their financials, their tax returns. And this is for people who really have the ability to roll up their sleeves and do their own analysis and comparison of these charities. My personal favorite one is, the next one is the Charity Navigator. And this is a site that actually ranks charities based on their effectiveness. So I think we would all agree that if there was a charity that gave 90 cents of every dollar they received from donors to administrative costs, right? Administrative costs being salaries, bonuses, meals, entertainment, and maybe company cars for the employees of the charity, that would not be a good, effective charity to give to. But on the other hand, if there was a charity that was spending 90 cents on every dollar for the actual charitable causes that it was designed to support, I would argue that's a pretty good charity. So you can actually compare charities side by side on Charity Navigator on what amount of money that's donated is actually going to the charitable causes. And then GiveWell is, again, if you're still not sure where you want to give and focus, this really helps you learn about the charities, what their missions are, what their causes are, and it'll help you narrow down where you might want to give from a charitable standpoint. All right, I wanted to show you this slide because it can actually get pretty complicated when it comes to all of the different ways you can give to charity, right? The most common one is just an outright gift, and that would be of cash. It's that gentleman who was just writing the 200 to 300 checks per year. But you can actually get pretty creative on how to give. One of the ones that we're starting to see more and more of is qualified charitable contributions from IRAs. And I'm going to talk about IRAs here later in the presentation. but that allows you to actually take up to $100,000 of a minimum required distribution from an IRA and allocate that to charity, which means, guess what? You don't pay income tax on the amount that goes to charity. So if you don't need your entire minimum required distribution to live off of, giving some or all of it to a charity is a great way to, number one, give charitably, but also to reduce your annual income tax exposure. We're going to talk about foundations and donor advice funds here in a minute. And we're also going to talk about how you might be able to look at estate planning when it comes to your will or trust in your estate plan. All right, so let's get a little bit more specific on what issues to consider when it comes to charitable planning. Obviously, you want to look at your desired charitable impact. You know, recall the example I gave you of that widow who, after her husband died, the door just opened wide open for her charitable giving. And of course, we want to, also look at the deductibility, right? There's very specific and complex deductibility rules depending on what type of asset you give, you know, how long you've held that asset, and so forth. And then also whether you have any retained interest in that charitable gift, right? Whether you get an income stream off of it. So we're going to talk about charitable trusts here in a minute, and appraisals. So when I am bored or have insomnia, you know, and I'm reading court cases in my bed to try to make myself sleepy, a lot of those involve court cases for charitable giving where appraisals were not done correctly. So if you don't have an asset that can be valued easily, like a stock or a bond or a piece of real estate where you get an appraisal, you have to get a qualified appraisal for IRS gift and estate tax purposes. And this is where a lot of people run afoul, such as if you want to gift artwork or something that's really hard to value, these valuation and appraisal cases a lot of times go to court with the IRS. And I just wanted to spend a little moment on family involvement. So you might be wondering, why do I have family involvement here on charitable giving? And in my experience, charitable giving is probably the #1 best way to get your family involved in charitable giving. And why would you maybe want to do that? So I'll give you sort of a prime example. One time I had a client who was an elderly woman. She was a widow, and she had 3 grandchildren. And these grandchildren were sort of in the preteen age group. And she got one of those smartphones, and she tried to call her grandchildren. They never answered the phone. Kids never answer phones, apparently. So then she tried texting them. Well, they never returned messages. They didn't even respond to texts. I mean, it's all like Snapchat and Instagram these days, right? So we were at a meeting. We had just concluded a financial meeting, and we were having small talk, and I asked her how things were going. And she said she was really frustrated because she wanted to have a better relationship with her grandkids, but it just wasn't happening. And I knew that she was charitably inclined, so I said, would you be willing to try an experiment? She leaned back and said, I'll try anything if it'll help me get a better relationship with my grandkids. And I said, do this. Get your 3 grandkids together and tell them, guys, I'm going to give you each $5,000. But don't get too excited. The money is not for you. Here's what I want you to do. We're going to meet again in 2 weeks, and I want you to each research charities that you're going to give this $5,000 to. And you're going to find out which charities appeal to you, which are interesting to you. And when we come back, you're going to share with me the ones you've chosen, and I'll help you deliver that $5,000 to those charities. At the next meeting, and 2 weeks later, the children were all excited. They couldn't wait to tell their grandmother which charity they picked and why, and they actually started to get a little bit competitive with each other of who picked the best charity. And this has actually become an annual event, and the kids can't wait each year. Grandma, when are we going to do our charitable giving this year, and how much are we going to be able to give? So this is just an example of how charitable giving can be used to enhance or to promote family involvement. All right, assets used to do charitable giving with. The simplest and most straightforward thing, of course, is cash. So if you just write a check to a 501c3 charity, that's the simplest and most efficient thing to do, obviously. And it's from a tax deduction standpoint, that also is the highest income tax deduction you can get. And if you give more than what you can deduct in the current year, you can carry that forward for 5 years, right? The good thing about that is the cash is available for immediate use for the charity. They don't have to wait for years. Whereas if you give appreciated securities or real estate, those first have to be put in a brokerage account, or if it's real estate, that real estate has to be listed for sale and sold. The good thing is you get that income tax deduction, not as much as cash, but you still get an income tax deduction. And one of the reasons why it's so good to give appreciated assets, such as securities or real estate, is because a lot of times those have a very low cost basis, right? So a lot of people don't sell appreciated securities or real estate because they don't want to incur that huge capital gain. Well, the good news is charities don't pay income tax and they don't pay capital gains. So if you give a piece of land worth $100,000 to a charity, but it has $1,000 or a zero cost basis, the charity doesn't pay any capital gains, and neither do you because you've donated the money, the property to the charity. And then the last one, I mentioned this a little bit when I talked about appraisals, is those complex, non-publicly traded assets. The main one that you hear about is artwork. You have to have that really good qualified appraisal. And that really has the most pitfalls. But again, you can minimize capital gains and the charity then sells that asset or maybe uses it for a while and then sells it. All right, don't get alarmed. I'm not going to go into detail on this chart, but I wanted to show you this just to illustrate the complexity that's out there for being very careful about which assets you do contribute to charity, and that there's different deduction thresholds for each type of charity, such as, appreciated securities. You have to look at if there's long-term holding or short-term holding. There's different deduction rates for that. So this is really where you need to consult with your tax professional, your CPA, to see what's going to happen from a deduction standpoint. All right, this is a pretty hot topic these days, private foundations and donor advised funds. So I wanted to go into a little bit more detail about these two entities. So private foundations, I get a lot of questions from clients about, hey, I want to give to charity, but I've heard about these private foundations, right? The most popular ones we've heard about are maybe the Bill and Melinda Gates Foundation, right? So a lot of people think, well, it would be really cool to have my own foundation. But I can tell you in my experience, it doesn't make sense to create a foundation unless you're going to do it with at least $10 million. So, if a client comes and says, I have $250,000, I want to create a foundation, I really try to dissuade them from doing that. And the reason is because there's so many legal, tax, and administrative hoops you have to jump through to run a foundation. And the IRS also dislikes foundations, so much so that they give you the least amount of income tax deduction, and it has the highest compliance and complexity and tax rules associated with it. So in order to make it worthwhile, you really have to have a lot of money to put into a foundation to deal with all of those legal, tax, and administrative burdens. And this is really one of the reasons why donor advised funds have become and are becoming so popular, because in essence, a donor advised fund is a private foundation without all of the hassle that goes along with it. So a donor advised fund is really just an account that you set up at a financial institution, and you give whatever amount you want to donate to charity to that donor advised fund. But here's the beauty of it. If you want to get an income tax deduction, let's say in 2022, then you would write a check or contribute assets such as securities to your donor advised fund. You would get the income deduction for 2022, but you could wait till 2023, 2024. There's no timeline on when you actually then have to disperse that money. So it gives you that timing flexibility for getting your income tax deductions that you want or need but flexibility in when those distributions are made. Now, remember the example I gave you with the grandmother and the 3 grandkids? You can do something very similar with donor advised funds. So let's say that your kids maybe are getting older, they're adults, they're moving away from home, they're starting their own families, and you're really not that close anymore. What can you do about that? Well, what if you had a donor advised fund and you reached out to your kids in a family meeting and said, hey guys, we're going to create a board of directors for our donor advised fund, and we're appointing ourselves, mom and dad, along with the kids as the board of directors. And we're going to have, I don't know, quarterly meetings, and we're going to decide how much money to disperse, and each person is going to be responsible for a certain amount of dollars that are dispersed. So each person, again, has to go out and do research on charities, maybe review grants, all of those kind of things. And at our next board meeting, we're going to vote as a board and decide what that looks like. So again, this is a really great tool to get the family together and doing something from a charitable standpoint. And guess what? When mom and dad are gone, if you've done this and established this for years, ahead of that time, the kids are likely to continue this when you're gone. So you can actually promote, again, that family harmony even after you're gone. All right, let's talk about, sure.
Sorry, just going to stop you really quick. On the donor advised fund topic, we have a question that came in that says somebody has a donor advised fund with, in this section, Fidelity Charitable. Do you have any recommendations or resources on how to contribute to international charities, or is there something that people should take into consideration if they're looking to donate internationally?
Yeah, you have to be really careful for that, because in order to get an income tax deduction, it needs to be a 501c3 charity, right? So one of the things to look for is if that international charity, and a lot of them do this, if they have an American, and I'm using quotes here, affiliate, that's a 501c3. A lot of foreign charities do that because they can get a lot more dollars from the United States if they have that American affiliate. So that's one thing to definitely look for. Now, if the income tax deduction is not important to you, that's a different matter. Make sense?
Perfect. Yeah, thank you.
All right, let's talk about charitable remainder trusts. So a charitable remainder trust is what I call a have your cake and eat it too estate planning and charitable planning technique. I'll never forget this. I actually had a client one time who I explained this to, and she immediately leaned forward and looked at me askew and said, Scott, is this legal? I laughed and I said, this is completely legal. This has been around for decades. This is a well-established technique. And let me explain to you what I mean about you have your cake and eat it too. So normally when you give assets to charity, as soon as you give those assets away, they're gone. You have no more ownership or control or anything with those assets. All you get is those assets out of your estate for estate tax purposes, and you get some sort of income tax deduction. That's it. The reason why this is the have your cake and eat it too technique is because you actually can get an income stream for life or a period of years from this trust. So let me give you a couple of examples. I work with a lot of business owners, and business owners really like this technique when it comes to pre-sale planning for their business. So if we get to them with enough time to put these kind of things in place, we could run the numbers and say, okay, if you contributed, say, 25% of your business before it's sold to a charitable remainder trust, what will happen? You fast forward and you sell the business, and you get 75% of the proceeds, and you'll pay capital gains tax on that. But the other 25% of the proceeds goes into the charitable remainder trust that you created. And there's no tax capital gains paid on that 25%. And then that charitable remainder trust is going to take that cash from the sale and invest it in a portfolio of marketable securities. And that charitable remainder trust is going to pay you an income stream for the rest of your life. Or if you're married, for you and your spouse's life. And that can really help with your cash flow planning to accomplish whatever your life goals are post-business sale. Only when you die, whatever is left in the charitable remainder trust goes to whatever charities you designate. Another type of situation where this is used very, very effectively is when you have, say, some low basis stock. I see it a lot of times when you have the proverbial $10 million block of Apple stock that the person bought right when Apple had its IPO, virtually zero cost basis. So you've got like a $9-point-something million unrealized capital gain. If you contribute that Apple stock to a charitable remainder trust, the charitable remainder trust sells the Apple stock and pays zero tax. You know, if that stock is not paying any dividends, you now are getting an income stream for life, right? And you're turning that sort of concentrated asset into an income stream. You're not paying any capital gains tax, and you're getting that $10 million out of your estate for estate tax purposes. So it's really kind of a win-win-win situation. Now, the cousin of the charitable remainder trust is the charitable lead trust. And the charitable lead trust is really the opposite. And it's just what the name says. So let's say that you want to do some charitable giving, but you also want to do some gifting to your family members. But for whatever reason, maybe because they're young or there's financial issues, maybe the family members are not quite ready yet to receive some substantial gifts during life. So what can you do? You can sort of have the best of both worlds and set up a charitable lead trust. So how does that work? So you contribute the assets to the charitable lead trust, you get that income tax deduction at the time of the gift, and then the charity gets annual payments for a period of years. And you decide what that period is. Maybe it's 10 years, maybe it's 20 years. And really the period of time is when you think your family is ready to get, you know, whatever's left in the charitable lead trust. So whenever that term of years ends, the charity stops getting any money, and then whatever's left in the trust goes to your family members. And of course, you control what that looks like. So they can get it outright, they can get it in trust, you know, however you want to structure that, you can do it. All right, so let's talk about retirement accounts for a minute. And the reason why I'm talking about this is because one of the things we're seeing in the financial world is that more and more often a retirement account, right, a qualified plan of some type, is one of, if not the largest asset in a lot of people's estates. And a retirement account poses additional issues when it comes to income tax planning and estate tax planning. So as an estate planning attorney, I can tell you that a qualified plan, a retirement plan, is a toxic asset when it comes to estate planning, a toxic asset. And let me tell you what I mean by that. So if you have a taxable estate, the current estate tax rate is 40%. So the IRA is going to contribute 40% of its value to whatever estate tax has to be paid. So in this example, we're using a $2 million IRA. So that IRA, when that person dies, will generate an $800,000 estate tax that has to be paid. And then if that IRA, via the beneficiary designation, passes to a child, and say that child is in the 30% tax bracket, what's happening? In the end, about 70% of the value of that IRA is being lost to taxes. You know, and if you think, okay, 70 cents on every dollar is being lost to taxes, that's a pretty bad deal, right? So in estate planning conversations, one of the things we ask a lot of times is, okay, look, when it comes to distributing your wealth to your heirs or your children, what's the right amount of inheritance for them to receive? Historically, the knee-jerk reaction has been, well, everything I have, of course, everything I have is going to pass to my kids. But more and more people are starting to ask the question, okay, well, what's really the right amount for them to receive? Because the biggest concern that I hear from parents is that they don't want to create a sense of entitlement with their kids. They don't want to create trust fund babies, right? And so each situation is different, but you may ask that question and say, oh, you know, if each of my children got, I don't know, $2 million or $5 million or $1 million, that's the right amount of inheritance, because number one, it wouldn't dampen their motivation or ambition. It would provide a financial safety net for them. It would enhance their lifestyle, right? If you can get your mind around that concept, that really opens the door to some charitable planning options with respect to your retirement plans. So if you were to say, okay, if my child got $2 million, what do I do with the rest of my estate? So because an IRA is a toxic asset, if you name a charity as a beneficiary from a tax standpoint, that's really the best result, because number one, your estate gets a charitable estate tax deduction. So that's, if you have a taxable estate, that's going to lower the estate tax because you get a charitable deduction. The charity doesn't pay any income tax, so 100% of that $2 million IRA is going to be used by the charity for its purposes. Now, let's say that you were to look at your assets and go, you know, I don't really want to give the whole $2 million IRA to charity because I really want my child to get X, right? X is that right amount of inheritance. There is sort of a compromise approach. We talked about charitable remainder trusts a minute ago. So you can actually name a charitable remainder trust as the beneficiary of your IRA or your qualified plan. And then the trust specifies that your child is the beneficiary of the charitable remainder trust. So again, your child gets those distributions from the charitable trust for their life or a period of years. Your estate gets an estate tax deduction, not 100% though, as the first option of giving it all to charity, but you still get a significant estate tax charitable deduction. And then your child gets an income stream over their life for a 10-year period. Now that income to the child is reportable on their 1040. You can't get around that. But again, just take a look at your balance sheet and your assets and go, you know, my IRA is, I don't know, 50%, 80%, 75% of my estate. What are the tax ramifications going to be on this if I die? And, you know, what's the right amount of inheritance for my child or children to receive? And, you know, how can I arrange things differently, maybe? And speaking of how to arrange things, this is a flow chart of what an estate plan might look like that really optimizes estate planning with charitable planning. So above the blue dotted line is when you're still alive. So you have your ancillary documents, your medical and financial powers of attorney, and your living will, right? Then this person has a pour over will into a revocable trust. The revocable trust is the primary estate planning vehicle that says what happens, you know, when the person dies. The person had, you know, a block of Apple stock or a business that they sold, and they placed that into a charitable trust. That's this green box here, while they were alive. So the whole time while they were living, they get this income stream from this charitable trust. And then they have the IRA. So when they die, let's start with the revocable trust. Personal property gets distributed, and then this is really good. Then there's a formula in the charitable trust that says, when I die, a trust for my child will be created. It's called a generation skipping trust. And that trust is going to receive the largest amount that can pass free of estate tax and generation skipping tax for my child's benefit. And what have we just done here? This formula actually zeroes out the estate tax. So no matter if they have, you know, an $80 million estate, because they've said, okay, my remaining estate tax exemption is the right amount of inheritance for my child to receive. Anything over and above that would go to charity. So you get a charitable deduction, and the IRS, Uncle Sam, would get 0 on estate taxes. The charitable trust, when you die, just pays out to the charities that you decide. And here's that IRA. So again, depending on what you decide, the IRA could just go outright to charity. Boom, 100% charitable estate tax deduction, no estate tax on that. Or you could create that charitable trust for the son, like we just discussed. So one of the things we really haven't touched on is investments. And one of the things to look at, and this is especially true if you have more than one money manager, is to look at how your assets might be invested. So let's say you kind of lean more towards that philanthropist extreme. And what a lot of people don't realize is that the way their investments are structured might actually be at cross purposes or conflicting with their charitable intent. And, sort of the perfect example is if you're supporting cancer treatment and prevention as part of your charitable giving, do you then also want to have some part of your assets invested in, say, tobacco firms or firms that do something that's contrary to cancer treatment and prevention, right? And it's really looking at your investments to make sure that they're aligned with your charitable goals. So as we bring this to a close, I wanted to sort of review some key takeaways. And the first one is to ask yourself, from your mindset, what kind of charitable investor are you, if you are one? So are you really more of the first example where it's kind of haphazard and you don't really have a cohesive plan of how you give to charity? Are you mainly doing it more for tax purposes? Or are you more leaning towards being a philanthropist? And is that during life? Or does the philanthropy really happen at death? And how should that be structured? The other question is to look at your estate and your assets, and do you now, or maybe in the future, will you have any estate tax exposure? So a lot of people who don't have a taxable estate now might have one in 2025 when the estate tax exemption drops back down to half of what it is now. So that's definitely something to look at. And how should your estate plan sort of be structured to deal with that and to get ahead of that curve? Take a look at your assets. Do any of your assets lend themselves maybe to charitable giving? Do you have maybe a concentrated stock position or a piece of real estate that you inherited, and maybe you're holding on to those assets because you really don't want to incur those capital gains? Those are perfect candidates for giving to charity, either outright or via the charitable trust that I mentioned. And then lastly, take a look at your family dynamics. Do you have children or other family members where it might be beneficial to get them involved in charitable giving as a family? And how would that maybe promote family harmony right now while you're alive and maybe after you're gone? So these are just some of the key concepts to think about when it comes to tax ramifications, family considerations, your assets, and your estate plan when it comes to charitable planning. Back to you, Jude.
Awesome, thanks, Scott. So we did have a couple questions that came in. I'll start with a fairly simple one. Are there limits on either a donor advised fund, a CRT, or CLT?
Well, on charitable trusts, you do have to do some number crunching, and we definitely have software to do that. I'll give you an example. So one of the things on a charitable trust that the IRS specifies is that when you run the actuarial calculation of what is going to be left for charity, there has to be what's called a 10% remainder test, right? So whenever you create a charitable trust, you have to make sure that what you fund it with and your age and the distributions you get actuarially will leave at least 10% for charity. Now, for outright gifts, again, you have that 5-year carry forward. So you have to look at your adjusted gross income. And this is something where you would go to your CPA and say, look, what was my AGI last year and what's my AGI expected to be this year? And here's what I'm thinking of giving to charity. How much of that can I deduct this year? And how much will I have to carry forward for 1, 2, 3, 4, or 5 years?
Perfect, thank you. Have you ever seen anyone make a donor advised fund the remainder beneficiary of your CRT for ease of changing the charity that it ultimately benefits?
Yes, I've also seen people name their donor advised fund as the beneficiary of their charitable foundation. And another thing that I see is, the people create a donor advised fund during life, they use it during life for their charitable giving. They maybe get their family involved, maybe they don't. But at death, they make a large bequest at death to go into the donor advised fund as well, and maybe name children as the successor managers of the donor advised fund to carry on the charitable giving.
Okay.
So it can really be mixed and matched depending on what you want to do during life or at death.
Got it. We had a couple questions that came in about the $2 million example. So the first one that came in was, I'm not fully understanding the $800,000 estate tax on the $2 million IRA. Isn't there the $12 million federal estate tax exemption?
Yes. So my example assumed that you had a taxable estate, right? So every dollar above the $12.06 million exemption this year, every dollar above that will be taxed at 40%. So if you had a taxable estate and you had a $2 million IRA, 2 million times 40% is $800,000. That's where that number comes from.
Perfect, thank you. And then in another question that came in regards to that $2 million example, how does the son get $100,000 regularly? Can you just explain that a little bit more in detail?
Sure. So in my example, when you create a charitable trust, you choose the percentage payout. So again, I try to make the math simple, but a $2 million charitable trust with a 5% payout, right? $2 million times 5% is $100,000. So the son gets $100,000 starting, that's the first year, and then it fluctuates each year. So if the charitable trust does well from an investment standpoint, the son actually can get more each year. And this is the arbitrage of a charitable trust that's so good, because if you get, say, a 6, 7, or 8% return inside that charitable trust, but the trust is only paying out 5% a year, that extra 2, 3, or 4% allows that charitable trust to grow each year. So that, number one, the charity gets more, and the 5% actually increases each year because it's 5% of the value annually.
Right. Okay. Awesome. A question on IRAs. So does it make sense to give out of my IRA during my lifetime?
Well, you can't really give out of your IRA during life, because that would entail a lump sum withdrawal, which would be a taxable event, which is pretty undesirable. I mean, this is where you start talking about Roth conversions, and it's really, the IRA is controlled by a beneficiary designation. So really at death is where you have all of your different options and flexibility of what to do with the IRA, whether it goes to a person individually. And one thing we didn't talk about because it's out of the scope of charitable planning is the Secure Act, right? That new 10-year time frame that beneficiaries have to withdraw retirement plans from. But it's really estate planning at death using your beneficiary designation of how you want that IRA or 401k to pass when you die. That's really the key right there.
Got it. What about a QCD?
That, of course, is during life. But again, the qualified charitable distribution has to go to a charity for you to get, not be taxed on that income.
Right.
But it can't go to family members or individuals. It has to go to a qualified 501c3 charity.
Got it. Now, can you give to a donor advised fund from your IRA?
The reason I'm hesitating is because I don't think so. I've never seen that. I mean, I think in order to get the income tax deduction, it has to go through a 501c3 charity. I'd have to research that, Jude, to be absolutely sure. The cleanest thing from an IRS standpoint is to give to a charity and not to a donor advised fund from a QCD from an IRA.
Right. Awesome. And it looks like we have one more question that came through. So with a charitable remainder trust, what if I don't need more income today? Can that be delayed?
Not really, because once you create a charitable trust, the IRS rules are pretty clear that same year you create it, the first distribution has to be calculated and go out. Now it's going to be a prorated distribution, but those distributions have to start.
Right.
So charitable trust would not be a good solution if you wanted to delay that.
Mm-hmm.
So it really comes down to a timing thing, though.
Yeah.
So if it's a business sale, for example, you really can't postpone your business sale because you don't want to create a charitable trust this year, right? The business sale takes priority. But you have a lot more flexibility if you have that highly appreciated asset like real estate or stock of what the timing looks like.
Cool. Perfect. Are there any other questions that anybody else has? We definitely have a few more minutes here for time for any other questions that come in. And I also just wanted to make sure I pointed out that if you do have any questions and you are an existing client of Mariner's, definitely feel free to reach out to your advisor. They'll be able to help out with all of this as well. Obviously, this is a very important part of a financial plan. They'll be able to help you and guide you through some of these recommendations. And if you're not a current client, feel free to reach out to your local Mariner office in order to get an initial consultation there.
Yeah, and especially if you're considering incorporating charitable planning into your estate plan, that would be definitely something to do.
All right, it looks like one more came through. So for the income from the CRT, is that taxable as normal income?
Yes, that's taxed as income. And I hate to get technical on you, but you asked the question, so I feel obligated to tell you. So yes, the income you report, the income you receive from a charitable trust is reportable on your 1040, but you're going to get a K1 from the trust. But it may not be dollar for dollar because trusts distribute out what's called distributable net income, DNI. So if you get, $100,000 in year one from the charitable trust, you may not have $100,000 of reportable income. It may be 70, 80, or 90, depending on the type of income in the trust. I know that's kind of a technical answer. So the first answer is yes, but it may not be 100%.
Right. That makes sense. Awesome. Any other questions that we have from the group here? All right, doesn't look like anything else is coming in. Scott, do you have any parting words for the group here? Any last golden nuggets?
I would just hope that, to the extent that, people are charitably inclined, or maybe if they weren't before, consider doing it, whether it's for tax purposes or whether you're, more of the philanthropist, that it doesn't matter what your motivation is, but there's so many reasons to do it. And the government definitely gives us perks and benefits for doing so.
Mm-hmm. And if, again, I'll reiterate what I mentioned a few minutes ago, but if you are unsure of what strategy is going to be best for you, reach out to your advisor. That's exactly why we're here as an organization. So feel free to reach out to your local advisor if you have one. If you don't, reach out to Mariner, and we'll be able to get you in front of somebody that will be able to help you out. Awesome. So then the last thing I'll end with, we will be sending out this recording and the slide deck to all of the attendees and registrants as well. So you'll definitely receive a copy of this sometime in the next week or so.
Thanks, Jude.
Yeah, thank you so much for the time, Scott. And thank you all.